Good morning and welcome to the Post-Monetary Policy Committee press briefing by the Central Bank of Kenya. Today is Wednesday, the 13th of August 2025, and the Monetary Policy Committee of the Central Bank of Kenya met yesterday, the 12th of August, issued its release. And so this morning, the Governor of the Central Bank of Kenya, who's also the chair of the MPC, shall be taking you through the deliberations of the MPC and some of the data behind that decision. And as usual, you're welcome to come in with your questions and comments on Slido. But just a reminder again, please make sure that you include your name and institution as you ask these questions. And for the most part, keep them within the MPC and the MPC's decision. But without further ado, I'd like to welcome and introduce the Governor of the Central Bank of Kenya and also Chair of the MPC, Dr. Kamau Thugge.
Thank you. Thank you, Wallace. During its meeting on August 12, 2025, the Monetary Policy Committee decided to lower the central bank rate by 25 basis points to 9.5% from 9.75%. The committee observed that the overall inflation is expected to remain below the midpoint of the target range in the near term, and this will be supported by lower food inflation, stability in energy prices, and the continued exchange rate stability. They also observed that central banks in the major economies have continued to lower interest rates, but at a more cautious and uneven pace depending on inflation and growth outlooks. The average lending rates in the domestic market have continued to decline, while private sector credit growth has continued to improve, although the pace has been less than desirable. The committee therefore concluded that there was scope for a further easing of the monetary policy stance to augment the previous policy actions aimed at stimulating lending by banks to the private sector and supporting economic activity, while ensuring that inflationary expectations remain firmly anchored and that the exchange rate remains stable. The MPC will closely monitor the impact of this policy decision, as well as developments in the global and domestic economies, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in October of 2025. In reaching its decision, the committee looked at global economic developments and the outlook. And they noted that despite the higher tariffs, the global inflation is expected to decline, supported by lower prices of energy commodities, mainly reflecting increased oil production by OPEC Plus and non-OPEC Plus producers, as well as subdued global demand. And as a result, the WEO, the World Economic Outlook projections by the IMF, project a deceleration of global inflation from 5.6% to 4.2% this year, and a further deceleration to 3.6%. And with this deceleration in inflation, the pace of monetary policy easing by central banks in major economies is expected to be more cautious and uneven depending on inflation and growth outlooks. In regard to international oil prices, these have moderated due to increased production and subdued global demand, but have remained volatile due to elevated global uncertainties. Oil prices increased in June of 2025 due to escalation of the conflict in the Middle East, but have since receded, reflecting increased production by the OPEC Plus and non-OPEC producers and reduced global demand. Major oil-producing nations of the OPEC Plus have agreed to increase their total crude production by 548,000 barrels per day from September 2025 as they continue to unwind the previous voluntary supply cuts. The main risks to oil prices relate to higher tariffs, which could have an impact on global energy demand, and also supply disruptions from escalation of geopolitical tensions, particularly the conflict in the Middle East. Turning to food inflation, food inflation has increased, largely driven by elevated edible oil price inflation, but cereals and sugar prices inflation have remained low. So global food inflation is projected to increase, or has increased, from 5.8% in June of 2025 to 7.6% in July of 2025. And the main reason for that is the sharp increase in inflation of edible oils, which has to a certain extent been offset by the reduction in prices of sugar prices, where inflation of the sugar was negative 13.5 in July. Looking at inflation in selected economies, the headline inflation in advanced economies has increased, partly due to stickiness in core inflation rates on account of persistent services price inflation. The U.S. headline inflation held steady in July of 2025 due to lower fuel prices, but core inflation rose faster than was expected. The UK inflation rose in June of 2025 on account of higher food and energy prices, while Eurozone inflation is on target at 2%. China's inflation remained low, mainly due to weak domestic demand. Turning to the global economic growth outlook, the effective tariff rate for the U.S. eased to 17.3% from 24.4% in April, while that for the rest of the world eased to 3.5% from 4.1%, and the U.S. had reached trade agreements with several countries. So global growth is expected to decelerate from 3.3% in 2024 to 3%, and then to 3.1% in 2026. The revisions were upward for 2025 by 0.2 percentage points, and for 2026 was 0.1%. And again, these revisions reflected the revision to growth in the United States and China due to the lower effective tariff rates in trade, and also due to improved global financial conditions. The improved growth prospects for the US, for the Euro area, the UK and Saudi Arabia could boost demand for Kenya's exports, diaspora remittances, inflows, and also tourist arrivals. Kenya's growth is expected to remain above the global, the emerging market and developing economies, and sub-Saharan Africa averages, mainly reflecting the resilience and diversified nature of our economy. In regard to the global financial conditions, these have improved as reflected in the recovery of equity markets on the left-hand side, and also the decline in sovereign spreads for emerging markets and developing economies, including for Kenya. So to summarize the global developments and outlook, the global inflation is projected to decline in 2025 as well as in 2026, and this will be mainly driven by lower energy prices and also reduced global demand. The central banks in the major economies have continued to lower their interest rates, but at a more cautious and uneven pace depending on inflation and growth outlooks. The global growth outlook for 2025 and also for 2026 have been revised upwards, mainly reflecting the lower effective tariff rates on trade and the improved global financial conditions. Risks to the global growth outlook remain elevated, largely due to uncertainties surrounding trade policies and tariffs, weak global demand, and heightened geopolitical tensions in the Middle East, as well as the Russia-Ukraine conflict. Kenya's real GDP growth is expected to remain above the global, the sub-Saharan Africa and emerging market and developing economies averages both in 2025 and in 2026. Turning now to the domestic macroeconomic developments and outlook, the overall inflation remained below the midpoint of the target range of 5 plus or minus 2.5% in July of 2025, but increased mainly on account of higher non-core inflation. So inflation, the overall inflation was steady between May and June at 3.8%, but in July rose to 4.1%, and this was largely due to the increase in non-core inflation from 6.2% to 7.2%, whereas core inflation only increased from 3.0% to 3.1%. And as a result, the contribution to overall inflation for core inflation remained unchanged at 2.2%, which was the same in June, but the contribution of non-core inflation rose from 1.6 percentage points in June to 1.9 percentage points in July. Looking at the drivers of core inflation, which increased in July 2025, this was mainly on account of higher prices of processed food items, particularly of sugar and maize flour. And you can see there in July, we have an increase in the processed food items. The contribution has increased from 1.1% to 1.2%, which pretty much explains the increase in core inflation from 3% to 3.1%. In regard to the drivers of non-core inflation, which rose in July 2025, and this mainly reflected an increase in energy prices. The three components of the non-core inflation is food, energy, and transport. Food inflation remained pretty much unchanged, but energy, the contribution of energy to non-core inflation, as you can see, between June and July, in July it was negative 0.6, and then in July it actually moved from a negative to a positive 0.3 percentage points, and this largely explained the increase in non-core inflation. And when you when you break down the elements in the energy, you see that what really pushed the energy inflation up was the electricity, which moved from actually a negative 3.4 to a positive 2.2%. And similarly, for the oil sector, for the energy sector, the pump prices, which had declined by 7.5% in June, only declined by about 1.7% in July. And therefore, one can clearly see that the increase in non-core inflation from 6.2% to 7.2% was largely because of increase in energy prices. Our forecast for overall inflation into the near term, we see inflation rising steadily, but mainly owing to seasonal factors, and then reaches 5.2 but by the end of June of 2026, we expect overall inflation to be firmly back below the 5% midpoint of our target range. In terms of expectations from the private sector, the MPC Market Perception Survey and the Agricultural Sector Survey show that inflation expectations remain firmly anchored within the 5 plus or minus 2.5% target range in the near term. With regard to the Agricultural Sector Survey, a majority of respondents to the July 2025 Agricultural Survey expect the prices of most food items to decline in the near term due to favorable weather and the onset of the harvest season for key crops, particularly maize. Nevertheless, respondents expect higher international prices of some processed foods and higher domestic prices of sugar to exert moderate upward pressure on overall inflation. In terms of the Market Perception Survey for the banks and the non-banks, this survey showed that inflation expectations for both banks and non-banks in the near term remains anchored within the target range on account of the expected stability in food inflation and global oil prices, as well as the stable exchange rate. So to summarize developments and outlook for inflation, the overall inflation at 4.1% in July of 2025 remained below the midpoint of 5% of our target range. Second, the overall inflation is expected to remain below the midpoint of the target range in the near term. This will be supported by lower food inflation, stable energy prices, and the continued stability of the exchange rate. The 2025 MPC Market Perceptions Survey, as well as the Agricultural Sector Survey, show that inflation expectations in the near term remain anchored within our target range. And finally, the main risks to the inflation outlook relate to inflationary impact of higher tariffs on trade, elevated geopolitical risks, uncertainty in the evolution of international oil prices, and higher international prices of key processed foods. Turning to the domestic economic growth, the growth of the economy is expected to pick up in 2025 and in 2026, and this will be supported by a continued resilience of key service sectors, agriculture, as well as the recovery of the industrial sector. The agricultural sector is expected to be supported by favorable weather conditions and the government's interventions such as the subsidized fertilizer. The services sector is expected to remain robust, leveraging on the digital economic transformation, and the recovery in private sector credit growth, which we will see shortly, is expected to boost activity in key sectors. And then finally, exports are expected to be supported by trade initiatives and bilateral agreements, including Kenya and China, the Kenya-EU Economic Partnership Agreement, and export promotion measures. So specifically, we expect agriculture growth to accelerate from 4.6% in 2024 to about 5.2% this year, and to remain at a high level of around 4.9 in 2026. In regard to the industry sector, we do see an acceleration in growth from 0.8 in 2024. We're expecting a recovery to 3.3 this year, and a further recovery to 3.7% in 2026. And this recovery will be underpinned by better performance in the mining and quarrying sector. The manufacturing sector is expected to do slightly better this year than last year, and to do also slightly better in 2026 at 3.3% compared to the 2.9% in 2025. And finally, with regard to the industrial sector, the construction sector is expected to recover. Last year, it only actually contracted by minus 0.7%. So far, in the first quarter of this year, it grew by 3%, and for the year as a whole, we expect a recovery to 4% and a further increase in value addition of 4.9% in 2026. The services sector should continue to remain resilient, and we do expect for the year as a whole for the services, combined services, to grow by 5.7% and a further 6.2% in 2026. I think just to add, with regard to the construction sector and also the services sector, that we do expect the lower lending rates by commercial banks to contribute to the growth of those sectors. And in addition, the improved government spending on development spending in 2025 compared to 2024, we do expect that will have a positive impact on value addition in the construction sector. And we also take note of the government addressing the pending bills in the road sector and also in other sectors, and that also should contribute to increased value addition in the construction sector as contractors go back to work. Again, looking at the developments in the credit to the private sector for some of the sectors, we see manufacturing, the turnaround in credit of banks to the manufacturing sector. From a low of minus 14.3%, it has increased to 2.4% in July of 2025. Of course, as we saw just a slide ago, we still are only projecting manufacturing to grow this year by only 2.9%, a slight increase over the last year. So although we do see a recovery in credit to the manufacturing sector, I think a lot still remains to be done to get manufacturing sector to grow at a faster pace than the 3% or so that we are projecting. On the other hand, we see significant increase in credit to the trade sector, reaching 12% in July. We see an increase in credit into the building and construction sector, which has gone to 38.8% in July. And for consumer durables, in a sense reflecting confidence in the, at least in consumption, the credit for consumer durables has increased to 10.3% in July of 2025. The CEOs and the market perception surveys also revealed sustained optimism about domestic business activity and economic growth prospects for the next 12 months. For the commercial banks, we see that 90% of the banks are either very optimistic or optimistic about growth prospects for the next 12 months. With regards to the non-banks, we see about 78% of the non-bank private firms also are either very optimistic or optimistic. And finally, the CEO's survey, we see about 77% of those surveyed expect growth to be either the same or higher in the next 12 months. And this optimism was attributed to improved agricultural production, supported by the favorable weather conditions, the stable macroeconomic environment supported by low inflation and a stable exchange rate, continued decline in interest rates, and expansion of the digital economy. Nevertheless, some respondents expressed concerns about subdued consumer demand, high cost of doing business, and increased global uncertainties attributed to higher tariffs and geopolitical risks. To summarize on the domestic economic growth, the economy remained resilient in the first quarter of 2025, with real GDP growing by 4.9%, and this reflected robust performance of agriculture, a recovery in industrial activity, and in particular construction. The leading indicators of economic activity point to improved performance in the second quarter of 2025. The growth of the economy is expected to pick up both in 25 and 26, with real GDP growth projected at 5.2% and 5.4% respectively. This outlook is supported by continued resilience of key service sectors, strong momentum in growth of agriculture, and the recovery of the industrial sector, particularly the construction sector. The MPC surveys conducted in July of 2025 revealed sustained optimism about business activity and economic growth prospects for the next 12 months. And this outlook is subject to risks, including trade policy uncertainties, heightened geopolitical risk, mostly in the Middle East, and also regional conflicts. Turning to the monetary policy implementation, as you know, we have a new monetary policy implementation framework, which is based on inflation targeting, and essentially we try to do monetary policy operations to ensure that the interbank rate closely tracks the central bank rate. And as you can see from that panel, if you go back to the beginning on August 1st, 2023, you can see there was a big difference between the interbank rate and also the CBR. But over time, we have refined this framework, and you can see in July, August towards the end that indeed the interbank rate is closely tracking the central bank rate. Following the implementation of that monetary policy, the short-term interest rates have declined further in June and July of 2025, which was in line with the policy decision to reduce the central bank rate. In August, you can see that now the 91-day Treasury bill is about 8.1%. The 182 Treasury bill is at 8.2%, and the 364 Treasury bill is at around 9.7%. These are significant reductions from around February or even August of 2024, when rates were in the range of 16 to 17%. And with the reduction in the central bank rate, followed by the reduction in the short-term rates, the commercial bank lending rates have continued to decline. Having peaked at 17.2%, they have now declined to 15.2%. And with that reduction in lending rates by commercial banks, the growth in commercial bank lending to private sector improved both in June and July of 2025, again reflecting this lower interest rate, lower lending interest rate by commercial banks. So you can see there the credit to the private sector was actually contracting at the beginning of this year, in January 2025, when expansion was actually negative at 2.9. But since that time, we've seen a gradual improvement in credit to the private sector, peaking July or reaching July at 3.3 positive 3.3%. Again, a quick summary of monetary developments. Money supply growth in June and July 2025 was higher relative to growth in a similar period in 2024, and this increase in money supply reflected the increase in lending to government, but also the improved lending to the private sector. Lending to private sector increased further in June and July of 2025, partly reflecting increased credit demand, with continued decline in lending rates and resilient economic activities. The short-term interest rates have declined further in line with the reduction in the CBR. And finally, commercial banks' average lending interest rates declined both in June and July of 2025, with a decline in short-term rates expected to transmit further into lower lending rates and improve lending to the private sector. Let me turn to the balance of payments. The overall balance of payments is projected to be in surplus in 2025, mainly reflecting expected surplus in the financial account. So in 2024, the current account recorded a deficit of $1.55 billion, and we expect widening of the current account to $2.07 billion in 2025. However, looking at item B there, the financial and capital account, we also expect inflows into the economy. Last year, in 2024, we had about $3 billion of inflows into the economy, which was more than sufficient to cover the current account deficit then of 1.5, and as a result, we had an overall surplus of $1.5 billion in 2024, and that, together with the disbursements from the IMF, permitted the central bank to build its reserves by $2.7 billion from about $6.5 billion at the end of 2023 to a peak of 9.3 at the end of 2024. As I said, for 2025, there's a slight widening of the current account deficit to roughly $2.1 billion. However, we still expect the financial and capital account inflows to be higher than the current account deficit, and therefore to have an overall balance of payment surplus amounting to $673 million And again, that will help us build our international reserves further by the $673 million. As I said, the current account deficit has narrowed in the 12 months to June of 2025 compared to a similar period in 2024. And this is, the narrowing has been from 1.8 to 1.6%, as can be seen there. And as I said, we do see a slight widening of the current account deficit in 2025 to 1.5 compared to 1.3% that was recorded in 2024. Looking at the performance of the various items in the current account, the goods exports increased by 7.7% in the 12 months up to June of 2025. And this was due to higher domestic exports, particularly horticulture, and that would be vegetables, fruits and flowers in that category. And also coffee did very well. Vegetable oil also did very well, as did clothing and accessories. For the year as a whole, we expect total goods exports to increase by 6% and to reach $13.2 billion. In regard to goods imports, these increased by 9.9% in the 12 months to June of 2025. And this increase was due to intermediate imports, and in particular industrial supplies, machinery, and transport equipment. And for the year as a whole, we expect imports of these same items to have increased by 7.8% and to record total imports of roughly 24 billion for the whole year. Turning to services receipts increased by 12.5%, again in the 12 months to June of 2025. And this was boosted by increases in transport receipts by almost 20%, and also travel receipts of about 21%. For the year as a whole, we expect services export receipts to increase by 6.4 to about $8.6 billion. Tourist arrivals have remained strong, growing by 9.9% in the 12 months to June of 2025. And this was on account of recovery of international travel and government measures to identify new sources of tourists. We have nevertheless seen a bit of a slowdown the first 6 months compared to the first 6 months of last year, when arrivals have only increased by 2.7%. But we do expect an acceleration of arrivals in the second half of the year. Remittances inflows have remained resilient despite increased global uncertainties, supported by diversified source countries and effects of government policies to export skilled labor. So thus far, in the first 6 months of this year compared to the first 6 months of last year, we see remittances increasing by 5.8%. And for the whole year, we are projecting remittances to increase by 6% and to reach $5.2 billion by the end of the year. So reflecting all this positive performance in the balance of payments, the foreign exchange reserves have increased significantly, and they continue to provide adequate cover and a buffer against short-term shocks, both domestic as well as external. The overall reserve position is about $11 billion currently as of August 11th, and this is equivalent to about 4.8 months of import cover. The Kenyan shilling has remained stable, supported by diversified foreign exchange inflows from what I've just mentioned, including diaspora remittances, the offshore banks, coffee, and all the other items I referred to. And we expect this stability to continue into the near term. We did take a survey of market perception survey regarding the exchange rate, and most respondents, 77% of the banks and 71% of non-bank respondents to the July 2025 survey expect the exchange rate to remain stable or strengthen, supported by improved foreign exchange inflows from diaspora remittances, the external support, and enhanced investor sentiment due to macroeconomic stability. Some respondents expect some pressure from increased imports, external debt service payments, and volatile oil and commodity prices. So to summarize on the balance of payments developments and outlook, the current account deficit narrowed to 1.6% of GDP in the 12 months to June of 2025, compared to 1.6% of GDP in a similar period in 2024, again mainly reflecting higher domestic goods exports and resilient services receipts and diaspora remittances. The current account deficit is expected to remain relatively stable at 1.5% of GDP in 2025 compared to 1.3% of GDP in 2024, reflecting continued good growth in exports, increase in services receipts, and strong performance of remittances. These deficits are expected to be more than fully financed by financial account inflows, and this will result, in the case of 2025, will result in an overall balance of payment surplus of $673 million, and this will help strengthen our reserve position to $10.7 billion compared to about $10 billion in 2024. The downside risk to the balance of payments outlook is increasing trade policy uncertainty, ongoing regional and global geopolitical conflicts, and uncertainty and volatility in the international oil markets. Turning to fiscal performance and outlook, the expected fiscal consolidation over the medium term should reduce debt vulnerabilities while moving the debt to GDP ratio towards a stronger, sustainable position. Currently, the debt to GDP ratio in net present value terms is about roughly 65%, and as you may know, our target is to reduce that to a sustainable level of 55%, and this fiscal consolidation that is shown here, where the deficit in 2024-2025 of 5.8% reduces to 4.7 in this current financial year, then to 3.5, then to 3.2, and finally to 2.7. That profile of deficit reduction would therefore be consistent with moving towards a sustainable debt position. Turning to the banking sector, the banking sector remains stable and resilient. The capital adequacy and liquidity ratios for the banking sector have remained above the minimum statutory limits of 14.5% and 20%. Currently, the total capital adequacy ratio stands at 20.4% in June of 2025, and that is to be compared with the statutory requirement of 14.5%. With regards to the liquidity ratio, it's at 58.6% in June of 2025 compared to the 20% statutory limit. The gross NPLs, non-performing loans to gross loans ratio, remained unchanged at 17.6% in April and June of 2025. Banks have continued to make adequate provisions for the NPLs, and the sector remains profitable, providing sufficient buffers. The proposed revised banking sector risk-based credit pricing model is expected to improve the transmission of monetary policy decisions to commercial banks lending interest rates. The performance of the banking sector, as I said, remains resilient as of June, and the asset base grew by 3.9% from 7.55 trillion in June of 2024 to 7.8 trillion in June of 2025, mainly driven by growth in the loan book. The deposit base grew by 4.6% from 5.58 trillion in June of 2024 to 5.8 trillion in June of 2025 as use of digital platforms was scaled up. So to summarize and some of the key takeaways, the global inflation is projected to decline in 2025 and also in 2026, while the global growth outlook has been revised upwards for both years, mainly reflecting the lower effective tariff rates on trade and improved global financial conditions. On the domestic front, the overall inflation remains anchored within the target range. The Kenya shilling has remained stable and is expected to remain stable. Interest rates have continued to decline, which should continue to support recovery in credit to the private sector and improved economic growth prospects. The proposed revised risk-based credit pricing model is expected to make lending rates more responsive to monetary policy decisions. With the stability in prices, as well as the exchange rate, the central bank has continued to support the government's economic growth objective, as reflected in the further lowering of the central bank rate. Thank you very much.
Thank you. That was the Governor of the Central Bank, who's also Chair of the Monetary Policy Committee, Dr. Kamau Thugge. And as is usual, we will go through your questions, not too many today. I think the decision was fairly clear. So beginning with George Obolutsa from Reuters. So George asks, what update is available about Kenya's quest for a new IMF program? And then he continues with what's the bank's latest update with regard to buying gold as part of its reserves. Kefa Moirore from the Nation Media Group says, or asks rather, how fast does the central bank expect to approve the new pricing models for loans by banks, noting that previously risk-based pricing approvals were quite labored? Stella Swake from Standard Investment Bank asks, does the Central Bank of Kenya maintain a target range for the government yield curve? Then finally, for this round of questions from Anna Nanjala Wekesa from the Kenya Times, who is asking how many banks have so far implemented the shift to using the interbank rate as a uniform base rate, and what measures will CBK use to monitor compliance?
Okay, thank you for let me start with George's Obulutsa's question on the IMF and also on the gold purchase. With regard to the IMF, we do expect an IMF mission in September to start negotiations on a new program. We expect that program, when it goes to the board, will be discussed together with the Article 4 consultation discussions. Our preference will be to have a funded program, and that is what we have expressed to the IMF. On gold, yes, we are still analyzing the potential for us to acquire gold as a reserve to diversify our base of reserve assets. There are teams that are visiting the country just to go and see the potential for gold, but I think just to make a long story short, it is our intention to diversify our reserve position and to include some gold element. KEFA questions is on how fast the CBK is expected to approve the new pricing models for the loans by banks. KEFA, I think we have largely converged on the model between the banks and the central bank. We have a meeting with the banks next week just to iron out one or two things. Once that is done, we expect the implementation of this framework because it involves quite a number of new things. We expect that the commercial banks within 3 months, all commercial banks should be able to have their models, their pricing models to be approved by their boards within 3 months for all the banks. And then once they have been approved, we expect implementation, 3 months of implementation. So in sum, we expect a 6-month implementation period. And of course, this is fairly short compared to what we had experienced in the last pricing model, which took quite a number of years for all the banks to comply. So, yeah, so within 6 months, we expect that to happen. The CBK, we don't really maintain a range for the government yield curve. The yield curve is determined by what is happening with the monetary policy, obviously, what is happening with fiscal policy. So that's determined by the market. Anna Wakesa, Kenya Times, has asked how many banks have implemented the new pricing model, and Anna, as I just explained, obviously no banks have yet to implement that, but we do expect everything to be done within the next 6 months.
Thank you very much. That's the governor. Just looking at, like I said, today is a bit of a thin day, so just looking through, most of the other questions have been answered one way or the other through other means. So without anything new, we want to leave it there for this post-MPC press conference. Like we tell you, the MPC meets every 2 months, so the next meeting is expected at the beginning of October. And so between now and then, unless there's something that calls the MPC into a meeting, we will see you at the beginning of October. But for now, thank you very much, and do have yourselves a good afternoon.